Okay, everybody. Welcome to this session on the public sector debt outlook for 2023. Apologies, we had one or two connection issues just there. So thank you all for being patient and waiting for the start of what should be a really interesting session. We're joined today, and we're delighted to have joined, I think, 300 people who have signed up to join us through the OMFIF Live forum. There's a very interesting mix of people in that list of attendees. Lots of investors, from fixed income portfolio managers to hedge funds, to central bank reserve managers, and some sovereign wealth funds as well. So welcome to all of our investors joining us today. Issuers from all corners of the world listening into what is to be said by some leading issuers and investors in the global space. So welcome to all of those borrowers who are joining us on the OMFIF Live platform, and a whole host of SSA DCM bankers for whom there's a lot of business amongst both our virtual panel and also in our online audience as well. Welcome to you all. My name's Clive Horwood. I'm the Deputy CEO and Managing Editor of OMFIF. Alongside me is Burhan Kadbay, who is the Head of Content for our Sovereign Debt Institute. Burhan and our research team here at OMFIF have been working very hard over the last couple of months on the result of a survey that we're going to be presenting the details and findings of today and discussing over the next couple of hours with a very prestigious group of people. So we'll come to those results in a second. We're going to divide the conversation up afterwards into three main streams. We've done a lot of work in terms of the survey, and there's a big discussion going on in the market about the relationship between sovereign issuers and their primary dealers, and indeed between borrowers and their investment bankers as well. So we'll start with a deep discussion on that. We'll then move into liquidity and demand and investor relations, a key topic. It seems at the moment the market is going incredibly well. It has turned a little bit on its head from a slightly gloomier outlook that we found at the end of last year. But we're seeing the markets going what can only describe as gangbusters at the moment. Order books of 60, 70, 80 billion euros on some of the big sovereign deals that we've seen so far. And then we'll move on to ESG and GSS bond issuance. We've asked some deep questions on that about the approach that issuers are taking to that market. And I know we have a lot of investors on the call today who'll be interested to see developments from there. Just to give you a quick run through of who's joined us from an issuer side, we have representatives from Brazil, from the EBRD, from Italy, from KfW, from the Council of Europe Development Bank, and last but not least, the European Commission, European Union. We have investors joining us to give their opinions and ask some questions of those borrowers. And we have those from Neuberger Berman, from Blue Bay, from Barings, from SSGA, from M&G, and from GemCorp. And with a pretty packed panel, we only have room for one bank, but if we're going to have one bank, we might as well have the one that's pretty much top of every SSA league table, whichever way you cut it. So Yanis and JP Morgan, welcome, and lovely to have you all here. Let's kick off with the presentation. I should point out that all of these results will be available in the report that you can download from the OMFIF website during this session and from then on, with all the key findings and a lot of analysis that Burhan and the team have worked on. But if we can start the presentation, we'll run through this quickly as we have a lot to talk about. As I say, we won't dwell on it too long, because if you want to stare at it and analyze it in depth, please do download the report. So if we just look at the summary of the findings, we can move on to the next slide. So OMFIF Sovereign Debt Institute's inaugural survey of public sector borrowers, which features 33 sovereign supranational agency respondents globally. The aim is to provide a perspective into the expectations and concerns of SSAs in the market. And also the focus is that we have, as I explained, on demand and liquidity, on investor relationships, on GSS issuance, and the role of banks and their issuers and the relationship therein. On to the next slide with some of the findings. What are issuers worried about? This survey took place between the 6th of December and the 6th of January. So at the end, mostly at the tail end of last year. Biggest concern is reduced demand from investors. If you look at the markets this month, maybe things have changed. We'll discuss that over the next couple of hours. But a concern certainly about reduced demand from investors. Higher new issue concessions. We're seeing that in some of the deals now, albeit to very large order books. Lack of clear issuance windows. Window seems to be wide open right now, but will it remain so over the course of the rest of the year? Interesting to note that if you take the top two concerns, then second on the list after reduced demand from investors are liquidity concerns. That'll be a big focus of our topic today. And there is certainly a lot of competing supply out there in the market right now. Next slide, please. So whether this now holds true, given the fast start to the year in January, we will see. But you would all know, I'm sure people joining us today, that in a standard year, you might expect sovereigns, supranationals and agencies to issue 60 or 70% of their annual funding requirement in the first half of the year. At the time of our survey, interesting to see that more than half of our respondents, and I should point out that a third of the respondents in this survey were emerging market and smaller issuers rather than just the big sovereigns and supranationals, saying that less than 50% of their issuance would be done by the end of the first half of this year. So whether that holds true today, we will see, but it suggests maybe that issuers are concerned that market conditions will deteriorate over the course of the year, or perhaps they might want to be waiting for better conditions in the second half. We'll see. Next slide, please. Order books are likely to shrink. This is a finding from here. What do you expect the average subscription ratios for syndications to be in 2023? Over the course of the year, we're not seeing the kind of inflated order books that have categorized some of the markets over the last 2 or 3 years, or even what we've seen this month. So around 40% saying that books would only be 1 to 2 times covered. Next slide, please. Greater emphasis on investor relations. No surprise if your biggest concern is worries about demand from investors. We'll certainly hear from our investors today on what they want in terms of communications with these important borrowers. 75% of borrowers saying they're deep in relationships with existing investors as a primary focus. 64% saying they're going to increase their investor relations efforts in the light of difficult markets and the reduction of central bank net purchases. And a good group saying that in reaching out to new investors will be an important part of their strategy over the course of 2023. Next slide, please. Issuers think they're going to pay more. Marginally more in most cases, although some think they'll be substantially higher, but the majority think they will, it's around 6% think that new issue premiums will be slightly larger in the markets in 2023. Very few think they'll be lower. A good group think they'll remain the same, but the majority think that new issue premiums will be marginally higher than last year. Next slide, please. We're going to focus, as I say, on the role of primary dealers and the relationship between primary dealers and their issuers over the course of the first part of our discussion. It's a topic that comes up constantly in discussions that we have in the Sovereign Debt Institute, often behind closed doors. We hope to bring some light to the conversation today with the survey results as well, and build a constructive dialogue on what's an important topic, not just for the issuers and their intermediaries, but also for the investors in the room today as well. So we can see here that 45% of issuers are thinking that providing more incentives to primary dealers is a great way to solve a problem that will also come up today, lack of liquidity in the market. Making more use of the repo market also. Interesting to see that it's more incentives to primary dealers rather than easy market making obligations that most issuers are focused on. Other tended to be something around sort of like repo or taps and various things like that. So next slide, please. So 40% of issuers that we surveyed say they already provide incentive schemes to their primary dealers. Around 35% say they're not going to do that. But more than 20% certainly are considering bringing in more incentives to primary dealers to be more active participants in the primary markets. And also, I guess, in the secondary markets as well, where primary dealers play an important role. So interesting that there's certainly an openness to a conversation about this subject. Next slide, please. So have primary dealers been going to their issuers to complain about this or to express their concerns, shall we say? Well, around 30% of issuers say that they have, and clearly the results of the survey say they're listening. So 70% say they haven't. Well, maybe they haven't directly, but certainly it is a conversation that comes up with primary dealers and issuers, for that matter, privately all the time. So we will explore ways over the next hour and a half or so how those conflicting concerns may be met in the middle. Next slide, please. Obviously, always in the debt space, a big interest in GSS bonds. We can see here that GSS issuance is becoming embedded and a core part of many issuers' annual funding requirements. Even those that are doing 0 to 10%, many of these are very big issuers, and these are very big numbers. But interesting to see that there are a group now of issuers who are allocating 20% or more to ESG or GSS issuance over the course of 2023. This is a big market, albeit developing in different ways, as we'll see in a second. Next slide, please. Advanced economies are prioritizing green bonds, but it seems emerging market issuers are looking at different markets. So green bonds are core to 65-ish% of developed market issuers, but actually big interest from developing economies in social bonds, sustainable bonds, and sustainability-linked bonds. And I'm sure our investors joining us on the conversation today will have some views about why that would be and what they're looking for. But the clear disparity there between developed market issuers and emerging market issuers. Next slide, please. So obviously one of the big innovations that we saw last year was sustainability-linked bonds and coupons that step up or step down depending on reaching certain KPI targets. And we saw Uruguay, and I think Chile as well, coming to the market with structures like that. Clearly, the jury is still out on this. There's probably more education that needs to be done, more learning, maybe to see how the deals already come into the market have performed. But this will obviously be a topic of debate, I think, in sessions like this for some time. There's a lot of interest, albeit not much of a consensus yet on exactly whether SLBs will become a core part of funding programs. And next slide, please. For all issuers, the issue of ESG ratings and communications around ESG and GSS are becoming firmly embedded in investor relations. We can see this in both advanced and developing economies. Developing economies slightly higher, but clearly ESG ratings are becoming more and more important, and discussion thereof between issuers and their investors. And next slide, please. Just a quick overview of where we come from in terms of 2020-22 activity. Compared to 2021 activity, markets were down in terms of volumes last year quite considerably in most areas. Start of this year suggests that numbers will be up this year. We shall see. So I hope you found all of that very interesting. As I say, please do download the report. You can see these charts and others as well in more detail. But to conclude, there are challenging market conditions that are prompting borrowers to revise issuance schedules and approaches to investor relations. Issuers are considering ways to deepen their relationships and offer more incentives to primary dealers in view of liquidity concerns. And as ESG ratings grow in significance, public sector borrowers will continue to drive the development of the GSS bond markets. So that concludes our presentation of the findings. I'm now going to hand over to Burhan, and he's going to focus now on that relationship between primary dealers, issuers, and what investors think about that. Burhan, over to you.
Yeah, thanks, Clive. So the first part of the discussion, we'll be looking at the relationship between primary dealers and their borrowers, so sovereign borrowers. As we saw in that presentation, 45% of DMOs are looking to provide more incentives to their dealers to boost liquidity, and 30% of DMOs have experienced dealers expressing concerns about their obligations. So hopefully we can dig into these statistics in a bit more detail with the borrowers and investors we've got on this panel. Yeah, we'll start with maybe Davide from Italy's debt management office. Have you experienced any concerns from your dealers about their market making obligations?
First of all, thank you very much for having organized this conference and for having invited the Italian Treasury. But I have to say that no, we didn't change significantly. I would say we almost didn't change at all the way we monitor and evaluate our primary dealers, both on the primary and secondary market. The reason being that we are quite satisfied in general by the way our market makers were able to cope with an increasingly challenging environment in terms of increased volatility. But nonetheless, we will keep on monitoring the evolution of the market, and because many things can still happen. But we think that if the the setup that we have in terms of monitoring, evaluating the primary dealers has worked somehow in last year. That has been a really challenging year. We think that the same system can work quite well with our methodology so far. So no particular change from our side, and we haven't heard particular worries from primary dealers with respect to the way we monitor them.
Okay, thanks, David. And we'll go into the sort of the methodology of how sovereigns rank their dealers in a bit later on. Maybe turning to Luis Felipe Vital from Brazil's Treasury. I suppose Brazil has a smaller primary dealer group than some of the big European sovereigns. Does that make it easier for you in terms of managing your relationship with your dealers?
Thank you very much. It's a pleasure to be here discussing such relevant themes with you. In Brazil, our primary dealer system goal comes from 2002. It was first created in 2002. And we have 12 primary dealers in the system. So this whole idea, I think it's part of a longer story here that we have to put in the context. So we starting in 2020, most sovereigns had to issue more debt to finance, to cover the financing needs related to the pandemic. And I believe that in most primary dealer systems, the primary dealers need to achieve a minimum share of the primary auctions. So in the moments where the Treasury is issuing more debt, of course, the primary dealers are having to buy more debt too. So this happened in 2020, and in a very specific scenario where investors were demanding more liquidity, and they had a very high risk aversion. So most sovereigns had to issue less risk or issue shorter bonds. So in 2021, 22, and probably to 2023, issuers are rolling this debt, trying to extend maturities. So we are putting more risk in the markets. We are extending maturity, and the primary dealers are having to work with this higher level of debt with longer maturities. So of course, it's to keep a minimum share of the primary market, it's harder for the primary dealers. And what we understand is that when we want to have a healthy primary dealer system, it has to be sustainable. So it has to be put in conditions where the financial institutions want to be part of this system. So not only last year, the years before, or every time the sovereign has to increase financing needs, of course, we are going to have financial institutions asking for this model to be more sustainable. And this is going to be sustainable in the sense that we can arrange the system so we can give more incentives and to keep the relationship good for both sides. So long story short, 2022 was the year of high financing needs, rolling over a higher level of debt, and we have to adjust our dealer system to keep the incentives aligned.
And how are you doing that, Luis? How are you adjusting your system? How are you adding more incentives, as you said? What incentives have you been adding to your deal?
In Brazil, our primary dealer system, it has two benefits that the dealer can ask for. The first one is that only primary dealers can be part of special operations. So exchange auctions, for example, only the 12 primary dealers can be part of this transaction. And the second one is what we call a green shoe option. So the primary dealers can buy the bonds that we offer in the auction in the following day. In the past, this option could be exercised in the same day of the auction. And when we move to the following day, it's like saying that this option got more value. So it's one of the options that we have to increase value for primary dealers. But of course, this has to be balanced every time the financing needs and the financial conditions change. So in a specific scenario, we had to adjust this obligation. In a different scenario, we can adjust that, of course.
Okay, thank you. That's very interesting. And bring in Siegfried Rohr from the European Commission, Horse Class Advisor to the Director General for Budget at the European Commission. The EU has a lot of primary dealers. Is it becoming more difficult for you because of your large primary dealer group to sort of manage that relationship? Are some of your dealers having, have they voiced concerns about meeting the EU's obligations?
Yeah, first of all, good afternoon to all of you, and thanks for inviting the European Commission here to this discussion. You're right, we have quite a large primary dealer network, 41 banks by 1st of January, maybe one of the largest, if not the largest, primary dealer group. But we also have, while the principles are similar to most of the standard sovereign primary dealer groups, system of obligations and rewards, we have here and there a different approach. We have low entry levels, and this is why we have this wide group. But then we have several rules: minimum participation in auction in the secondary market, which define which role a bank plays in our primary dealer group. But it's not us who is deciding on that. It's a business decision of each bank, and depending on the role they play, they have access to the rewards. Every primary dealer can call himself a primary dealer. Every primary dealer can and has to participate in auctions, so has the exclusive access here to our bonds in auctions. But if you want to play a bigger role and be eligible as a lead manager for our syndicated transactions, and we have a decent number of syndicated transactions and a decent volume to be issued via syndication, then you have to comply with higher criteria. So this is a concept which works quite well, and so far we haven't received complaints away from the usual complaints. Bankers are always complaining, right? Jan is right, about our primary dealer system. It's a quite young system. We just established it in 2021 when the diversified funding strategy for NGEU, our program, was established. So we have now 1.5 years of experience. Overall, the last transactions of the 1.5 years have confirmed that it works well. But we are also adjusting it a little bit. We announced in December that we will implement a system which should encourage primary dealers to quote on electronic platforms, especially on B2B platforms, to further support the secondary market liquidity. But also this will follow, to a lesser extent, an obligation system. It will be a rewarding system. As a primary dealer, we will discuss the details with our primary dealers and develop this together with them. But the current idea is it will not be an obligation, but if you do it, you will be rewarded in gaining points for the internal ranking, which increases then your eligibility to lead mandates. It's more a rewarding system we have in our primary dealer group management than an obligation system.
Right. Okay. So it's more of a rewarding system than a strict quoting obligation for your dealers on the electronic dealer platforms. Okay, we've heard from Brazil about the incentives that they've been offering. I want to turn to Davide in Italy, because Italy, you've got quite a unique system for rewarding dealers, with banks receiving fees proportional to their allotment and bond duration for auctions. Could you talk us through how that works and the changes you've made to that fee model this year as well?
Sure. So I'll try to give a little bit an overview on how we monitor and evaluate our primary dealers, and then the system of incentives. So on the evaluation of primary dealers, we have quite a complex mechanism made of several parameters that we use. And each of these parameters attributes a maximum number of points to each of our primary dealer. So they can move for a maximum number of points, and then all the others are, evaluated on the base of the specific index that we are considering. Now, these parameters goes from the primary market, and so we have, of course, a minimum threshold, as Felipe was saying, in terms of allocation at the auctions over the year. And this parameter, of course, take into account the duration of the securities that we place through auction. And so each primary dealer has to get a minimum amount on a percentage terms. But then, of course, they get more points up to a cap. They can get more points if we go beyond this minimum threshold. But as I was saying, these points are capped in order to avoid, too much aggressive behavior of dealers in primary market, and to avoid what we call normally overbidding. So trying to avoid that the price at auction comes too high with respect to secondary market levels, because we know this is something that then tend to keep final investors out of auctions. Instead, we want them to participate through the primary dealers as much as possible. And so that's why we've been working a lot over the years, not just in this way, but also through other parameters that basically tend to give less points to those dealers that bid at auction in too aggressive way. On the secondary market, we have several other parameters that take into account the quality of quotation, the amount of volumes traded, the number of bonds traded, and the debt that each dealers contribute to provide to each bond in the market. We take into consideration, first of all, the interdealer market, but we also take into account the trading activity that is carried out outside. Now, based on all these parameters, we get a ranking, and this ranking is updated continuously. It's communicated on a quarterly basis, and then at the end of each year, we publish the first 5 ranked banks in our ranking. Now, so based on these ranking, but not only of these, we have one first system of incentive, that is the participation in syndicated transaction. So for each transaction that we want to bring to the market through syndication, we choose primary dealers based on their performance, so on the ranking. But definitely ranking is not the only variable that is used to take this decision. Of course, we have also some type of rotation system. So we're trying to involve as many primary dealers as possible on one side. On the other side, of course, we're trying to also take into consideration those primary dealers that are better positioned for the specific transaction that we are considering, the specific bond or instruments that we want to place in the market, because we know that some banks are better placed than others in distributing a certain type of bond. So that's the first important incentive. There are other incentives. One is exactly the one Felipe was mentioning. Is we have also a green shoe. So we reopen at a price set in the auction, the bond the following day after the auction. So the auction of this second auction price is already set. So we basically are providing a free option to banks, and the quota that each bank has participated in this green shoe is set on the base on the performance on the 3 previous auctions on the same bond on one side, but it's also based on the performance on several parameters on the secondary market. So this means that if you are very well performing on both the primary market and the secondary market, you have a wider green shoe. So you have a wider option at your disposal if you wanna take it. Finally, and probably this is very important too, is what you were mentioning. So we have been always paying fees to primary dealers that participate in bond auction, not in T-bills auction, but in bond auction. Each primary dealers gets a fee proportional to the amount that is allotted at the auction, and of course, this fee is set depending on the duration of the bonds that we are considering. Now, this year, and I'll conclude, we have introduced a small but probably significant change because we basically told the dealers that the amount of fees they're going to get, of course, will be based on the allocation at the auctions, but it will be marginally reduced at the end of the year if their performance on the secondary market is particularly unsatisfactory. So if a primary dealer is too much distant from the median one, or more than the median, let me say, on the average primary dealers in terms of performance on the secondary market, if you are too much distant from these average primary dealers, you're gonna get a small marginal reduction in the total fees that you get on the primary market. In this way, we even if, as I said in my initial intervention, that we were satisfied about how the dealers behaved last year. Of course, there were some of them that were kind of behind, kind of far from the rest. So this mechanism is try to bring more dealers near the average and not to have some of them too much distant from the average. So that's the kind of change that we have introduced this year to somehow, hopefully, further improve the functioning and the liquidity in the secondary market.
Okay, thank you. Just quickly, how are you measuring being too distant? I mean, how do you define being?
Well, as I was saying, we have a set of parameters for the secondary market, and based on these parameters, each of them you get a point, and you sum all these points on these parameters, and then we get a ranking, and so it's a secondary market ranking, if you want. And so then we look at what's the average number of points, and we see where the worst performer on the secondary market have placed with respect to this average. If basically the distance is too wide, according to a parameter that is set in our decree, then basically it means that you are too far, and you will be applied these fee reduction on the primary market.
Okay, thank you. Perhaps we'll bring in get a DCM perspective. So Yanis Rallis from JP Morgan, head of SSA DCM. Yanis, I mean, what JP Morgan, I mean, continues to add primary dealerships. I mean, you've added new ones this year, and you're quite active and have a strong presence in this market. What do you look for when joining a PV group, and what incentives could DMOs add, and what else could they do to ease the pressure on banks? I think you're on mute, Yanis.
Yeah, we can't hear you, I'm afraid.
No, we still can't hear, I'm afraid.
Not right now. Maybe just while Yanis is sorting out his mic. I just wonder whether any of the investors have a particular viewpoint on this. I mean, it all seems like a conversation between the borrowers and their bankers at the moment, but obviously, as investors, you're looking for liquidity, access to the markets. Patrick, I want from you, Bergamo, I wonder whether you have a view on this.
Sure. Thanks for the invitation. Of course, the liquidity question is a relative one. I mean, I listened to all the organization and of the GMOs and which improvement we had the last years, but the liquidity was a great one thanks to the ECB, the central bank's behavior, thanks to the liquidity which was injected. So when I listen to what you mentioned, the first comments and the survey, I think the liquidity shouldn't be as good it was when the central banks were every day ensuring all the liquidity. And I was thinking about the Bank of Japan question about the yield curve control. The liquidity for me, it's including all the bonds of the yield curve for governments, are perhaps more for Brazil than for some issuer like European Commission. But of course, the liquidity for investors, it's a curve of liquidity. You have to have a fine-tuning of the curve. You can invest according to your client's needs because we haven't one client. We should have different views because we have short-term investment, long-term investment, insurance investment. So we should have a curve for issuers. So it's typically what we are looking for. Agencies, sub-sovereign. We would like to have not a liquidity, but I would like to say a bid and ask for which we can invest and disinvest when we would like to do for our clients. So we are not speaking about corporates, we're not speaking about banks investment. It's not tactical, of course, but it's a fine-tuning. So when we look for the market evolution, this year is key. And that's the reason why you organize, I think, this conference, because we have years of perfect liquidity, but also no risk. The risk was very low, thanks also to central banks and cash injection. So a part of a question you raised today is also to restore the risk premium, the liquidity premium, which disappear. So that means that we should expect a different adjustment this year in terms of liquidity. So I don't want I don't know what question we like to raise, but of course, a part of the question for me was about the volatility, the market volatility. Last year was one of the largest sell-off in the history of the bonds market. So the spread, the bids on the primary auction on syndication were perhaps lower because of market volatility, and we dislike the volatility, as you know, as borrowers. We like to know the price this afternoon, tomorrow morning, when we like to bid to an auction. If the market is moving too quickly, it's for us a big issue. And for me, of course, we expect that the rate volatility was due to the central banks adjusting their monetary policy from low negative rates, 0 rates to normal rates in the Eurozone, for example, but also the end of the QE. So we have a large adjustment which put pressure on the auctions, on the syndication. And the second leg of our analysis as a borrower, we used to compare such investment not with the AAA government bond, which is the bond in the Eurozone, but with the swap spread. And last year, the pricing we can have on secondary market, but on also the primary market, was had a distortion due to the swap yields. The bond scarcity explained a part of that. The bank's hedging strategy also explained that. But last year, up to now, the swap spreads were very wide. And of course, it changed the way we price, as you can expect, public investment, public issuer strategy, because the swap was really very cheap, and the curve was inverted. So for us, the swap was also a question in terms of pricing the bonds. And the last point, as you understand, we are looking for currently with public sector is to invest for our client needs, and which is the next topic, I think, Clive, but the green bond and the social bond. We have really a bias. We would like to find liquid issuers, liquid investment, and public issuers match, I think, such a investment for us.
Okay, thank you, Patrick. I think Yanis, your mic is on now, but let me just take a question from Abhishek. I can see your hands up. Abhishek Kumar from State Street.
Yeah, hi. Thanks for the opportunity. It's very interesting to hear all the issuers speak about liquidity and the focus that they have on on primary dealers. We, as you know, a very large part of our book of business is to manage ETFs, exchange traded funds, where liquidity is prime concern because especially last year when there was a lot of downturn and volatility, investors were looking to redeem out of our ETFs. So providing liquidity is quite important. Now, there are some structural issues which unfortunately can't be avoided. Like there are taxes. So the taxes are in some cases are based on the holding period. So the longer you hold, the more tax, the lower tax you have. But sometimes bonds are zero coupon bonds. Therefore, you have held bonds for a shorter period of time, but the volatility last year meant that you were in deep profit. Selling those bonds can be quite expensive. And therefore, many times issuers issue a lot of bonds because they don't like to tap existing bonds but issue more bonds. So you have a huge curve, and primary dealers only focus on 5 or 6 bonds, but you can have 50 bonds in your curve. Now these orphan bonds are where we hold bonds. We obviously don't hold the entire book in 5 bonds. We hold them in 50 bonds, and when we have liquidity needs, we would sell these 5 bonds because those 50 bonds are orphan. They don't have primary dealers supporting them. Or we have structural issues like taxes, which means that the pressure on these 5 bonds is enormous, which the primary dealers obviously face because they have to make markets on the bonds which everyone is selling, no one is buying. So if the issuers can think about removing these structural issues, which might be quite difficult, I understand, but it might be a useful way of improving liquidity and at the same time making work a bit less for the primary dealers. Needless to say, primary dealership and issuing bonds in primary market is very important, but to long-term investors like us and those who need liquidity, having liquidity in secondary markets in the older bonds might actually be a lot more useful than the newly issued bonds.
Okay, thanks, Abhishek. Yanis, coming back to you for my original question, but also you got a response to the investors' comments as well.
Yeah, absolutely. And now everyone can hear me now.
Yeah, all good.
Fantastic. Yeah, apologies for the technical issues before. So how do we look at primary dealerships? Obviously, a first step has to be to consider and to think about whether we have the investor base to distribute the bonds to and also to trade the bonds to. We then look at the obligations that the issuer is imposing on the primary dealers. So this can be quoting obligations, it can be bidding obligations in auctions, it can be obligations on the takedown, reporting obligations, and other things. And then finally, what has been already mentioned, the incentives or rewards that are being offered by the issuers to the primary dealers, which typically are a mix of fee-paying bond syndications, swaps for hedging of those bond syndications, and the non-comp or green shoe, as Philippe said, for auctions. So these three things form basically the financial rewards that can accrue to the primary dealers. But there's obviously also the opportunity and the drive to actually make more trading revenues by actually having a bigger position in that particular bond market, and that it is typically there is a correlation between being a primary dealer, having access to those liquidity events that auctions are, that enables you as a bank to take bigger positions, make bigger trades with your clients, and hence offer another avenue to actually create revenues.
Okay, thanks, Yanis. That's really interesting. I see Simon Kujana Evans from GEMCO as a question. Simon?
Yes, hello. Thank you so much for the invitation. A very interesting survey, and I think very helpful for all of us, both on the sell side, on the buy side, on the issuer side. I think, look, coming from the emerging market side, I do see bigger risks, if you like, especially also in the developed market side. And I think that what we're seeing here is that the future really depends on the efficiency of the bond markets. And this efficiency requires more, if you like, regulatory efficiency, a streamlining in the whole process. So this whole primary dealership function works, that there is liquidity in the market, that you don't get situations like the LDI crisis in the UK last year. And let's face it, as debt to GDP levels rise in developed market countries and ratings fall and QE is wound down, we are getting into a more difficult situation as far as issuance is concerned. And we are, for many developed market countries, getting into a situation where ratings approach those of emerging market countries. And what we're seeing in EM countries is that this lack of liquidity, that banks not being able to hold the bonds on their books, on the balance sheets because of the lower ratings, etc., this can easily happen in developed markets or so-called developed markets. And I think that we should be addressing this, regulators together with issuers, and I think that the US issuers should be pushing for some solution here. We shouldn't be always just relying on central banks to save the day when things hit the fan, basically. So I think this is something that we need to take on board and take into account for the future. Otherwise, we can have some big crises.
Okay, that's interesting, Simon. Just a reminder to our virtual audience, send in the questions and we'll aim to answer those as well as at the end of the Q&A session. As a sort of segue into we've only got a few minutes left, but as a segue into the next session on market conditions and liquidity and investor relations, I want to open up to the non-sovereign borrowers here. So the likes of EBRD, KfW, and Council of Europe, and sort of ask the question about how your relationship with your lead managers has evolved in recent time and how you're managing that relationship. So is there anyone, I mean, maybe we can ask Isabel at EBRD, I mean, that question.
Thank you very much for inviting me to participate. I'm very glad to be here and to listen to problems also that we don't have, as well as thinking about the ones that we do. In terms of relationships with dealers, I think it's been pretty transparent for some time what the fees are for different things. So if you're doing syndicated transactions, it's much easier to establish a basis. I know that some peer groups, and maybe this is a subject for slightly later, have focused on trying also to integrate ESG considerations and other things into their selections of lead managers. I have to say that's not a basis on which we've sought to operate. We've sought to focus on a number of different aspects, including the fact that people are committed to make markets in the secondary market, the fact that we get a lot of additional information. They work with us on investor relations, and the kinds of additional transactions that we do away from the large-scale syndicated market. So those are the criteria by which we tend to judge relationships, rather than putting together some kind of form with ESG, which we do look at in relation to where we make investments and follow the money, thinking about Paris alignment and other aspects, but definitely not in terms of the selection of our lead managers.
Okay, thanks, Isabel. And Petra, quickly from you, I mean, is that a similar way that you sort of manage relationship with your deal bank? Sorry.
Well, first of all, also from me, thank you to bring us together here. It's very interesting. So KfW has also a kind of scoring card, which we have for the banks where we work with in the syndicated business. Those are about, let's say, 20-ish banks, obviously a mixture of American, Canadian, German, and all the international banks who are able, from our point of view, to place our bonds in euros and in dollars. So who have the market expertise, capabilities, and the investor access. And for the scoring card, we have different parts. That's one is the non-benchmark business, as we say. You know, we have a broad range of MTN business on the private placement side, which we do, where for us, it's first of all, it's a cost-efficient business. And second, it's an investor diversification. So looking at last year, we even find new investors in the MTN space who join later in the benchmark business. Then we look at the derivative business. We look at taps on the euro side. I just want to mention that because we talked about liquidity, so KfW doesn't do any auctions. Therefore, we do taps on our benchmark bonds, which are not in the same way fee earning for banks as the normal syndicated benchmark business is, but where we are very close to the market and see that we find the right prices, and at the end of the day can deliver liquidity up to 7 billion issuance. So our benchmark bonds in euros are 3 to 5 billion, and we can tap them up to 7 billion. We usually do that in big chunks, like 1 billion, and also have a look at how the bonds are placed. So this is our approach, which is the alternative to, let's say, perhaps the angle of the auction business. It's also cost efficient and delivers liquidity. In addition to that, we look at investor relations activities, and the overall relationship. So, and we have different weights for those segments. And secondary markets obviously is also one of those parts where we have a semi-annual look at whether we need to change something. And this is something where we have a very good opportunity to fine tune, you know, if market conditions change, or coming to your question, do we need to deliver more incentives for banks? So we can fine tune a little bit, right? From which segment we get which information, right? And on the secondary market, that's something where we also monitor the turnovers and have a conversation with the banks. So, I mean, at the end of the day, the scoring card should ensure that we can long-term place our bonds in the market, that we have an efficient market approach, and that investors can have liquid KfW bonds, which do perform well. Okay. On ESG, just to add on ESG, that's a criteria which we have an add-on criteria, which is the ESG rating, which we add on this scoring card if we mandate for green bonds. But it's one additional criteria. The main scoring card counts for the whole business.
Okay, thank you, Petra. Now these issues we'll look at in the next session, but quickly from Arturo from the Council of Europe Development Bank. Arturo, thank you for joining us. Do you score your banks in a similar way that KfW does? And are you looking at other incentives for your banks as well?
Yes, good afternoon. Thank you very much for the organization of this call. Yes, well, we as the other, like Isabel and Petra, we only issue by syndication. We do not do any auctions. So we have a scorecard internally which takes into consideration these different aspects. We are very following very closely distribution capacity of different banks. Probably we're working with around 25 banks which may act as lead managers, and we try to optimize by their capacities, you know, in terms of geographical capacities. So at the end of the day, what we try to do is incentivize by depending on the scoring that we get from different feedback in terms of secondary market capacity, general information that they give to us, the global relationship, taking into consideration other products as derivatives, but also on the treasury side. Then we incentivize, in terms of getting to the benchmark transactions, the banks which are really giving the best support. So that's, I presume, very similar as the other supranational institutions. And what we have as eventually a different aspect is that we are a medium-sized issuer, so we don't have huge amounts of issuance per year, which means that we need to try to make a rotation and distribution in terms of what we can do with each issuer at any time. And we try to be fair in that sense in terms of incentives to have everyone on board in the yearly activity, but eventually with not everyone being in a benchmark transaction per year. So that's I would say an extra challenge for us to keep a good relationship with banks, even if sometimes they know that they may not be in a benchmark every year. So that's challenging, but it's because of our size. We nevertheless try to do the best to have everyone on board in, I would say, in a 2 years perspective.
Okay, thank you, Arturo. And then now Clive will carry on the discussion on liquidity as well as market conditions and investor relations for our next session.
Thanks, Burhan. It does sometimes seem extraordinary that we have some of the biggest issuers in the world launching multi-billion-dollar benchmarks on a regular basis, and yet liquidity remains a deep-seated and troublesome issue for the markets generally. Suggests there may be some structural flaws in the market that need to be addressed. But Brian from Barings, I just wonder how do you see liquidity in these core markets? And do you have any suggestions to our panels on in the end, I suppose it's the issuer's responsibility to make sure that their securities are liquid. Anything that you see that they could do to improve liquidity?
So I think the issue of liquidity, it mostly reflects the contemporaneous market conscience. So because we had yield surging, volatility surging, central banks tightening, and an impression that all of this flash liquidity is going to go away, which has been raised here, that's what's being reflected here to say, are we transitioning to a new normal where, people who would want to buy these extremely cheap bonds don't have the money to do so? Or is it that banks are quite restrained in how they take risks, so then maybe they're not able to play? So, I mean, having been doing this for about 17 years, I just think that you get to see these waves come and go, and then you have to ask yourself, what are the structural forces? So my view is I'm not particularly concerned about liquidity. And why is that? It's because you have to look at the bidding that's coming through on these bonds, right? The bidding is extremely strong. And that tells you that investors who have been invested in equities or are long of cash for various reasons are seeing incredible value in these markets. So that's what leaves me not particularly concerned about liquidity, because the evidence suggests that the money is being deployed into these markets. And we are extremely bullish on these markets because we know these are once in a generation valuations, right? I always joke with my clients to say the last time bonds were this cheap, I had an afro, and my afro is not coming back. And much like these valuations may never come back in a long time. So in summary, I'm trying to say what I'm hearing more is just the fears of what we've seen recently. But structurally, I think these markets are going to continue to enjoy liquidity being deployed there. There's going to be volatility because you start getting these regime shifts. That's part of the process. But if you ask me 2-3 years out, am I worried that we're going to see markets struggling to clear these bonds? The answer is no. And then, so what advice would I give to the issuers in terms of trying to improve liquidity? I just think the market just works by itself, really. If the valuation is there, you will find bidders coming in, and if the valuation is not there, then you struggle to clear the bonds. So I don't really think that there's anything structural that's changing in these markets. So that's why I'm a bit relaxed, as you can hear from what I'm trying to say.
Well, and in these very busy markets that we've seen already this year, does that suggest that you think there's a very realistic level of pricing in the market, as well as the fact that underlying factors make these very good value, but the market is pricing in a responsible way, or even an attractive way?
I do not think so, because we invest a lot. I think swaps markets were being mentioned, and one of the things that we look at is the implied volatility in swaps markets, just to see where markets perceive, the markets are trying to perceive the violence in terms of rate movements. And when you look at swaption volatility, US, UK, or Europe, even though it's topped out, it's still extremely high. And what that tells you is investors are still not sure where bond yields are going to go. And generally, what people like when they're investing is some kind of certainty, some kind of confidence that yields are going to be here, or like the European Central Bank is not going to go crazy. So what's my point? My point is the liquidity, at least for developed markets, liquidity conditions are poorer than they've been before. But they're just reflecting that we've just gone through a period of aggressive hikes. Now, in the long term, you're going to be worried about QT, about ECB doing QT, Fed doing QT, Bank of England doing all of this stuff. You will be worried about that. But at the end of the day, when you look at where the money is being put to work, that's the evidence in front of you that despite the volatility, investors are coming to buy these bonds, and that's what gives me the assurance. And we are buying as well in this volatility.
Thanks, Brian.
Yeah.
So we have a couple of more emerging market focused investors with us today. Jana from Dubai. In the emerging markets, obviously liquidity is always an issue. Smaller issues not coming like most of our borrowers here in huge benchmark size. Where do you see the responsibility for more liquidity in emerging markets should lie? If there are, and we have many emerging market issues listening in, what would you ask of them to help you as a borrower, as an investor, in terms of making sure that you're investing in more liquid assets?
Hello, and thank you for inviting me, and good afternoon to everyone. So, I mean, I'm not necessarily sure that issuers need to do more than they are already doing. I think from the emerging market point of view, and from my point of view as a hard currency investor, I think what's important is for issuers to sort of keep an eye on their curve and do a responsible liability management exercises to make sure that all the bonds on their curve, all the points on the curve are in sort of sufficient sizes, such that they can be traded and they can be easily accessible by issuers. But other than that, I don't really necessarily think that issuers need to make extra efforts to increase liquidity in that regard to what they already do.
Okay, thank you, Jana. We'll come back to you in a second on this. Gregory, maybe we can just bring it from M&G. Maybe we can just bring you in here. We've not heard from you yet. Any views on this liquidity question?
Yeah, absolutely. It's been a remarkable year already. In October, sentiment was rock bottom for EM. By the time people were doing their year aheads, they were better. And then we've come back in January and we've seen a dozen or so EMs come to the market. But where does that liquidity run out is what interests me. So far we've seen two single Bs come to the market, Mongolia and Turkey. Mongolia had a very clear narrative that there was no new net debt. It was telling investors, we're just doing liability management here. So we're not raising new money, we're refinancing. I think that narrative helped them. The deal ended up being a bit confusing, but they got it out, and but they still paid close to 9% yield at issue. Turkey came with a 10-year, and that was closer to 10%. So the question is, the liquidity's there, but for a lot of sovereigns, it's not there, because once you get to 10%, these bonds are a coin toss. They don't necessarily get paid back, and that's the upper limit. And I think, between 2010 and 19, the US 10-year averaged 2.4%. So we're now looking at 3.5%, and where it goes is uncertain. So what we've got to question is that the sort of bonds that came out 800-900 basis points spread above 2.4 probably aren't viable now. So we probably won't see in the foreseeable future a single B doing a long bond. And for some sovereigns with refinancing there, it's going to be really tough. So while I'm seeing, exactly right, one of the previous panelists said, the liquidity comes when the valuation's there, but there isn't, at some point, you can't pay anymore. And so it's going to be tricky for a lot of single Bs unless the market rallies further.
Thanks, Gregory. It was clear at the end of last year, and I mentioned in my opening remarks, that the outlook was a little bit gloomy. It seems very, very positive now. Yanis, just to come back to you. Obviously, you've been in the centre of these markets the last few weeks. Does this feel like the state of play for some time to come? Or is everyone taking advantage of the window while it's there? And then I'll come to some other panelists to ask them what they think is going to happen going forward. But obviously, right now with this super liquid market, do you think it's going to persist?
I think having been in this market now for almost 20 years, we know that the sunny days don't last forever, right? There's going to be a turn. Typically, this turn is some kind of shock event from the macro side, or even a geopolitical thing. I think when I look at the research right now and the commentary and the media, what seems apparent is a dichotomy between maybe the central bank rhetoric on inflation and the path of interest rates and what a lot of investors are expecting. So to be clear, I mean, investors, I think, expect the pivot of central banks a lot earlier than what central banks try to convey. And that's going to be interesting, if that could at some point potentially lead to a waking up call, right? So a big change in valuations and in how the market sees the future, right? But to your point also, definitely right now issuers are making use and of very good, very decent market conditions, much better than what most people had expected and forecasted for early 2023. We see order books that are almost as big, if not bigger, than during the heydays of QE, but a lot more quality in these order books, so they are less inflated as what we've seen previously. Issuers are being able to print very large transactions, like 13 billion Spain yesterday. And we also see on most transactions a decent secondary performance. So I tend to think there's a good feeling for both sides of the market, both investors and issuers right now, when looking back at the first 3 weeks.
Thanks, Janice. Jana, I'll come back to you 1 second. I just wanted to ask Siegfried, because I think Siegfried, on your first big transaction of the year, you built a 63 billion euro order book. Was that a surprise to you that the orders were so large for that deal?
Well, we were quite confident when we opened the book for this transaction, based on the feedback we got from our primary dealers. Also, an important role of primary dealers here to give the advice on to the investor. But I have to confess, it was better than expected. Yeah. So it was a very strong order book, not only in terms of numbers, but also in terms of quality. And yeah, it confirms that markets are working well. And also, while we are looking at your statistics, we are concerned about demand, concerned about liquidity. The new situation also shows opportunities. Higher yields bring investors back. We had during QE, often I heard complaints about there's only a one-way market, there's only a bid in the market, and investors are squeezed out. Now we get a different type of liquidity back and a different type of demand. So I think each challenge has also its opportunity here, and it looks at the moment that the market takes these opportunities.
Thanks, John. I think you had a question that you wanted to put around whether this phenomenal start to the year might actually change some of our issues here today in terms of what they think their funding plan for the year might be, or the way they approach the market.
Yes, that's right. I mean, I found it quite interesting that the survey was relatively negative in terms of expectations of the market condition this year. And it was also reflected in many of the expectations in terms of the issuance that we're going to see this year, especially from the emerging market side, which was indicated to be net negative post amortizations. And I just wondered, looking at the very, very strong January market, which was, only matched with very strong inflows into the asset class. And I imagine the same for other credit asset classes. Are issuers reconsidering their issuance plans, perhaps in terms of shifting issuance further, closer to towards the start of the year, or even reassessing how they split their issuance between hard currency or local currency, or even perhaps refunding 2024 issuance and taking the opportunity of this window?
Would any of our issuers like to answer that one? Maybe Petra, does this fast start to the year change your outlook in any way?
Well, not really. I mean, our aim was in January to start with the euro and the dollar benchmark transaction, and that's what we did. In the first week we had a euro benchmark which we placed into the market, a 5-year this time. And in the second week, we did a dollar transaction. I mean, obviously, this year there is a real first mover advantage, because the first transactions also, they went very well. We also did sterling and Australian dollars, better than expected. That's true. But does that change our plans? Well, we have somehow an idea how we do the first quarter. We also have a target for summer, like 70% usually we do until mid-July. And also I would say it's more fine-tuning, right? The Chinese New Year is very early this year, so I think that pushed a lot of issuance in the first 3 weeks. Also, we have the impression there is a lot of liquidity just because year end there were not so many possibilities to invest. And so this is something where we somehow benefit from now at the beginning of January. So we use those opportunities, but that doesn't mean that we really have to change our plans already. I think especially if you look on absolute yields, it's really surprising to see how 10-year rates or even 5-year rates went down. And it also shows that there is a huge demand. So somehow everybody's sitting there waiting that it might change. But so far, yeah, that hasn't happened.
Okay, thanks, Petra. Davide, I think he wants to come in here.
Yeah, unfortunately, for some reason I cannot switch on the video. No, I want just to add the point on what was saying regarding the performance since the beginning of the year. So the one element that characterized this start of the year is the fact that despite the expectation of increased volatility of rates and spreads, what we have seen is that even in large transactions, I mean, we carried out a 20-year bond for 7 billion, which, I mean, it's quite a decent amount of DO1 that is placed in the market. The secondary market performance was quite relevant, and so the bonds tend to trade at more or less the same level at where they were placed, or even tightening. But this is a common feature I've seen as other transaction. For example, you know, so Spain has carried out a very large 10-year bond. And what was impressive is to see the market digesting this paper very well. So another way to look at it, beyond the quality of the books and the amount of orders and the number of orders, is also the performance of the secondary market. Despite structurally the underlying market keeps on being volatile, this is not really significantly changed, but this volatility seems to be quite exogenous to each individual syndication. So it's not syndication itself that it's bringing volatility in the market right now.
Okay, thanks, Davide. Just in terms of coming back to Luis from Brazil, we've heard a lot about liquidity. We've heard a lot about demand. Is this something, Luis, that you hope to find in the market for Brazil over the course of this year? Luis, hopefully, I think you might have frozen. Let me come back to Luis. I just want to talk about the investor relations side of things just for a second. And actually, two of our borrowers here have new commitments, shall we say? Well, three if we include EU as well. But certainly in terms of EBRD and Council of Europe Development Bank, as well as your traditional funding, there are questions around how much you're going to do for Ukraine and the investor relations work that you're doing around that. Isabel, maybe you could sort of like tell us a little bit about the overall investor relations framework, but also how Ukraine is becoming part of that discussion. Then I'll come to Arturo on the same thing.
Thank you. Yes, I mean, we never have a dull moment at EBRD because working with emerging markets, I think it's true for many of the MDBs. It's often at the epicenter of some of the sort of things that are going on, whether it's, a pandemic and now the Ukraine war. We've had coups in countries in the past, things that are always happening. So investor relations is a very sort of live discussion always about how we approach things, looking at various portfolios. Obviously, Ukraine and Russia portfolios have been very much in the spotlight, in fact, since 2014, and not just during the war, but what more that we're doing and how we're doing it and how that will play out and what the portfolio expectations are and size of operating assets, looking at capitalization, all those different things is a very active discussion. And, things fundamentally change. I know some people have said, well, I've been doing this for 17 years or 20 years or something like that. I've been doing it an awfully long time and even longer. And before the global financial crisis, very much people would take it on the basis of the rating, and the kinds of discussions we were having with investors was much more superficial. And even the kinds of conversations we were having with credit rating agencies was more superficial, I would say, than the kind of in-depth discussion, the teasing out, the real trying to understand the portfolio, operating assets, capitalization, all the policies. Those are things that a lot of depth of discussion is now undertaken with most of the investors, as well as with the rating agencies. And there are often very significant updates. The marvel of all having discovered Zoom and other electronic media has meant that it's also easier to have supplementing physical discussions with additional Zoom discussions to keep things up to date and to have a much wider understanding as things change. So I think that it's been a very different experience. And I know we're talking about ESG later, but also the requirements for many investors to understand that too has really given a completely different both breadth and depth to the kinds of discussions we're having. I think one thing that's worth noting is that because we talked about liquidity, in the global financial crisis, there were significant concerns suddenly that multilateral development banks such as EBRD don't have lenders of last resort, and they don't take deposits. So in fact, liquidity is a very live issue and was given subsequently much greater weight in the rating agency methodologies, where they also focus on funding very significantly. So are you funding to a broad enough investor base, both by geography and by investor type? And so having those kinds of views has meant that we need to think much more about being geographically diverse, about appealing to those with different types of market strategies, be they frontier funds, be they ESG funds, other types of asset managers. Getting the breadth, both by geography and investor type, is really important in ensuring that we're able to continue to be active in the market, irrespective of whether or not one market is having a problem.
Okay,
So,
thanks. Well, that's really useful. I'd just like to come to Arturo. Same thing. I mean, Council of Europe, I think, expanded lending program, therefore expanded funding program. Ukraine membership. How is that all weaving into your investor relations work, Arturo?
Yes, absolutely. That's affecting a lot because, well, as you know, our main mission is we have a unique social mandate, and our main mission is to promote social cohesion across Europe. And with the latest crisis, first the COVID-19, then the Russia's aggression against Ukraine, and the situation of the refugees in Ukraine arriving to neighboring countries, that has affected the bank a lot in terms of the activity. First, in the lending activity, the volumes have increased in the lending front. So therefore, on the funding perspective, we need also to raise larger amounts than in previous years. And this is having a lot of discussion with investors and in the investor relation activity in three fronts, I would say. First, in the front of having a new strategic framework for the bank for the next 5 years. We will integrate all those needs. Second very important front is the acceptance of Ukraine as a member of the institution. Ukraine will become a member as the administrative process goes on, very likely in the coming months. And then lastly, to confront all those needs and challenges, the bank has decided, the Administrative Council of the bank has decided to grant a capital increase. And all these three aspects, they are very important for the institution and needs to be very well communicated to investors. If I talk about the capital increase itself, it's very important because the first capital increase where we will have a paid-in part in cash in the history of the institution, which will allow to have subscribed capital at an increase of 80%. So roughly will come from 5.5 billion to almost 10 billion of capital subscribed, and then in the paid-in part of the capital, we will come from 600 million to 1.2 billion, which is triple in terms of paid-in capital. So that's very important for us. Then the second point is well, what is our relationship in the Ukraine situation? The bank is being very fast at being able to grant the first needed funds. It was the same with COVID-19. When COVID started, we were creating what we call a fast-track procedure. Disbursing a loan may take long, and we decided to do it as fast as we could. And some COVID-19 loans were disbursed in only 3 months. We have done the same thing in the Ukraine conflict situation, and neighboring countries receiving refugees from Ukraine. They were very rapidly receiving loans to be able to cope with the needs in terms of not yet integration, but just the first stage of the integration, I would say. And we were able to grant loans up to 1.3 billion very fast in 2022. Then in terms of Ukraine situation, we were also able to grant loans for emergency situations at the first stage of the crisis, and we did it through we did that to the Migrant and Refugee Fund, granting something like 6.4 million. It may seem a small amount, but these amounts are sufficient to give a blanket, some food in the first situation of the crisis. And then, as I mentioned, Ukraine is becoming a member of the institution, likely in the coming months. So this is being accepted by the Administrative Council, also with no charge to Ukraine for entering in the bank. So all in all, we are doing quite a lot of things in terms of the refugee crisis from Ukraine, including also social inclusion bonds, because given that we have extra needs in terms of funding, we decided to also issue some social inclusion bonds directly related to the Ukraine refugee situation. And we did last year 2 social inclusion bonds related to Ukrainian refugees, 1 billion euros and $1 billion.
Okay, thanks. I'm sorry, I'm going to just cut you there because
Sure.
We're right. I'm going to, Luis, I'll come to you in a second. We had a problem with your mic before. I just want to come on the investor relations side to Siegfried, because of course, Siegfried, I mean, we talked about, finding new investors or developing deeper relationships. There was a point 18 months ago where every investor in some respect was a new investor. So talk us through where European Commission and EU bonds are now in that investor relations process, and what your priorities are and over the next year or so.
Yeah, thank you, Clive. It's an important aspect you mentioned here. It was just 18 months ago when the NGEU funding started, something we tend to forget. But this is the reason why on our side, there is on the investor side a large need for information. On the one hand, about what is NGEU, what was implemented here 18 months ago, but at the same time, things are developing. And we have topic Ukraine. We had last year to raise, in addition to the funding for NGEU, we had to raise 6 billion to support the Ukraine. Then the member states agreed on another 18 billion package called MFA Plus for 2023 to support Ukraine. So a lot of information we have to provide to investors, and a lot of need on the investor side, and we feel that when we talk to them for this information, we use here, of course, our website as it's a very efficient tool, and transparency is a crucial element of our market approach. Put all kind of information on the website, but it's important, this is what we also see on a day-by-day basis, to talk directly and in person to people, to answer questions and to explain things further. And at the same time, investor relations is not only a one-way flow of information from the issuer to the investor, it's also important for us to get their feedback about what we are doing, what are their needs, where can we improve. So it's really an important part of our work, investor relations. However, as we are the young and the new kid on the block, also something we are still building and have to develop further.
Thanks, Siegfried. Luis, just to come to you quickly on Brazil, just to round up some of the things that we've been talking about here. First of all, what do you think the market demand for big emerging market sovereigns like Brazil? You obviously have a new government and maybe a slightly more outward-facing government than there happened before. Obviously, a lot of people would like to buy Brazil. It's a huge part of the emerging market indices. So first of all, what do you think about market conditions for your issuance? And secondly, what investor relations priorities do you have over the coming year?
Thank you so much for this question. So in terms of external debt, Brazil does not finance itself externally. We keep an external debt curve so it can be used as a first contact of investors with Brazil, with the credit, and as a benchmark for most of Brazilian corporates. So it's not an active financing instrument for Brazil. And we've been out of the market last year. Last year, we had some volatility. We had a year of elections in Brazil. We have a lot of volatility regarding our fiscal framework that was under discussion. So we were out of the market. And it was interesting because during last year, I saw some of my peers like Uruguay, Chile, Mexico. They had very interesting transactions in the external markets, ESG related, and that's something we have to congratulate them. And Brazil is looking forward to being in the same place in the near future. So we should expect Brazil to be back in the external market in 2023, and we have been working in an ESG framework with the World Bank and IADB, so we can work on thematic issuance. Mostly investors they give a lot of importance, and of course Brazil does give a lot of importance for the environment component. So we are looking forward to be back in the market in a bond related to that. And trying to answer the question about investor relations, there's something we learned from last year is that in moments where investors get very curious because there is a lot of noise regarding your credit, the best thing to do is keep being transparent with investors, keep having meetings with them, and even discussing with them what is true, what you know, and what's going to happen. And even when you don't know, discuss with them, let them know what is not under discussion, what are the uncertainties at that very moment. So from what we've seen, this broader transparency, it has been giving very good results with investors. On the other perspective, in local markets, we have been seeing a significant flow for investors in the local markets, but for a very specific reason. The fiscal framework in Brazil is getting more clear, and in terms of the cycle of monetary policy, Brazil is in the end of the tightening cycle. So it's actually offering rates that are significantly higher from what we used to see. And we are seeing more demand from international investors. So we keep being transparent with them and holding meetings with foreign investors.
Thanks, Luis. I'm sure we're going to come back and talk to you about the ESG thing on the market. Very keen to hear more. And obviously, Berhan's going to do that session in a second. I just wanted to come back to Abhishek. You talked earlier about some areas in which there was a lack of liquidity. You talked about the orphan bonds. I don't know whether there's a solution to that. Is the solution from your side that you really do focus just on the bigger, more liquid issues? And does that mean that you slightly, if that's the case, you slightly limit the range of investment you can do because there are just a lot of issues out there that can't provide that kind of size and liquidity in the long term?
Yeah, yeah, liquidity is definitely an issue in many markets, and I know many investors think that issuers are doing already enough, but I think there's still a lot that the issuers can do to make the markets more liquid. Obviously, the proof is in their concerns, right? Obviously, the bid offers are not good enough, which means that liquidity needs to be addressed. Yes, so reducing the size, reducing the number of bonds that they issue definitely would make a big difference. Like if you think of this, like I'm just taking, there's nothing to be taken personally, but Turkey has a fairly large number of bonds, and Turkey has been in a very difficult spot last year. They have a very strong primary dealer network and system. If you look at the bonds, the primary dealer bonds are not actually the bonds that they tap. They can tap a different bond, while the primary dealer bonds, where primary dealers are obliged to make markets, may be different. So then it opens up a fairly big dilemma where the bonds that are issued actually might come in at a reasonably cheaper level than the PD bonds, because they are more liquid, which opens up problems for the issuer itself, because they're paying more money. And also, if you think that the old orphan bonds in Turkey are less liquid, so if you have those old orphan bonds, especially in inflation-linked bonds, it's virtually impossible to sell them. If you have an inflation-linked product, there's literally one bond we can sell. So you are limited to your entire liquidity exercise in just one bond, one PD bond, which makes it very challenging to manage to offer liquid products in emerging markets. Again, I'm touching on ESG as well, just as we have this opportunity. The same situation is happening in ESG GSS bonds as well. For example, Hungary has issued a couple of, or three of them, local currency ESG bonds, but they are small in size and they are not index eligible, which means that these bonds could have had far bigger falling from indexed managers if they're bigger in size. I understand there's a liquidity aspect to it, and there's they're trying to balance the curve and build the curve and all the good things. But the immediate consequence is that the bonds are, again, too small, very difficult to get hold of. You have to buy in the primary market. Secondary market liquidity is not there. So yes, issuers can help a lot by making life a bit easier for buyers who need more liquidity.
Okay, thanks, Abhishek. You've segued beautifully into the subject of ESG, so I'm going to hand the baton over to Bilhan quickly to take up that story.
Thanks, Clive. So there's a lot to unpack here. We've got questions from the virtual audience as well on this, on ESG matters as well as questions from investors on this panel as well. But to start off with, as we saw in the presentation, the sustainability-linked bond market isn't really taking off with developed market sovereigns. Only EM sovereigns. We saw obviously two debut issues last year with Chile and Uruguay, and potentially a third this year, according to our survey. I just want to turn to maybe Gregory, M&G. I mean, firstly, why is this product why has SLB product sort of taken off with EM and perhaps not so much with DM sovereigns? Gregory, if you can perhaps answer that.
Yeah, it's a great question, and I hadn't noticed the degree to which, until I'd read this report, there's a big stark difference. And interestingly, also in literature, this idea that the greenium really isn't there in developed markets, and it certainly isn't there for emerging markets. So what is the objective of doing these things? And it seems to me that at least when we go into developing countries, a lot of the countries haven't done much carbon emissions over their history. So for them, it's less about transferring away net zero, but more about climate change adaptation. And hence, given the main challenges developmental, maybe the wider sustainability brand or the social brand makes sense. But it's something certainly to unpack, and it's a small but growing area. Yeah, I've got some. It's interesting also. The other point was of the survey about the two-way pricing structure, which is a debate for the SLBs, that 3/4 of people weren't sure. So that's quite interesting. Either people aren't following them very closely, or we don't really have a consensus, and that's quite interesting. And I think something that needs to be thought through more over the next couple of years, because at least in my opinion, it seems that sometimes the incentive to do the things you said, or the penalty if you don't, are not big enough to really change behavior. And often we're finding that these bonds are just a small part of the curve. But I think over time this will obviously change. And so I think it's an important area, and it's good to see EM leading on the sustainability side. The only sort of question I'm left with is what are the fees for these type of operations? And there's been a lot of good press about debt, climate for nature swaps, but people also pointing out the huge fees involved for the syndicates and the external verification. So I'd like more transparency there to be able to assess if sovereigns are getting value for money.
Yeah, thanks, Gregory. Yeah, that's interesting. Maybe Patrick, I'll turn to you, Patrick Barb at Neuberger Berman. I mean, someone that works with investment grade and European sovereigns. Patrick, can you hear me? Yeah, just ask you a question about.
Yes, of course.
Yeah, sorry. About the SLB product. I mean, what would it take just for this product to take off with European and sort of IG sovereigns? Would the step up need to be revised, for instance, or anything needs to be looked at or changed from what EMs have been doing in SLBs?
Well, it depends because there are many different questions. Because our job is to represent investors first of all as an asset manager. So we have different countries in USA, in Europe, having different, to be clear with you, different objectives. If we consider perhaps more the public sector issuers and the private, of course, our clients are more interested, and that's your survey perhaps result. They are more focused on project, because when we are speaking about different criteria, it's more long-term investments, long-term evolution. Our client would like to sponsor. So it's clear that in Eurozone, it's perhaps more a project bond, green bonds, for example, than ESG bonds, which is more for, I think, developing countries. So there is a kind of split. Myself, I'm not managing developing markets. I'm managing European market. So I think in European market, the question there is at the start, because what we discuss with the issuers and the client is more the way to motivate. And to come back to the question about the step up and step down on the coupon, the question is to align the alignment of interest between the investors and the issuers on the long run. It's not today to have a deal, a green bond, ESG criteria, which get the funding, and then 1 year, 2 years later, it should be something else. I mean, it's difficult to follow all the criteria. Who knows if a green bond are really invested in the green project on the long run? So we have the analysts to do that. So for me, there is a credibility of the process of all these criteria for each issuer, each bonds, because it's taking time to analyze if you have done something, yes or no. And of course, you have to define a different measure. The contribution, it's a long story. So we develop that, to be clear with you, with corporates, because for corporates, the incentive is perhaps more important than for public. In the Eurozone, for example, the step up and the step down the coupon, it is written in the report you publish. The 25 basis point is perhaps too low. The motivation, yes, is but it should 25 basis point. It's really a motivation if you issue a 30 years bond. If you issue a lower bond, 10 year, the cost for the company is low compared to the reputation, as you mentioned in your report. So for me, we have to perhaps to fine tune the different way to manage such an investment. Of course, what was more important perhaps was to get a kind of maturity for corporates, because for corporates it's quite more important, because these criteria should mean default. It could be the same for public entities, but for corporates you can have more impact on the bond's value. Usually for government, it's more a long-term story. And for me, the issue, the long-term, is that you can have different governments, different type of motivation. Today, I faith in the sustainability of the policy of the European Commission, but it should not be the same in other areas. So this is for us the question to follow the follow-up. The follow-up and how easy is to manage the reports, the spread. The greenium is now low for green bonds, for example. The green bonds are the same price. So the market is perhaps at the middle between the two to have pure portfolios and more active portfolios. As a portfolio manager, we used to have objective in terms of performances. So for us, what is important is to have better performance, or to find a way to justify a performance which makes sense for investors. So what we are missing is a kind of benchmark. You know, the green benchmark, for example, has too long duration. So according to the time, we should have more diversification on the curve, which is not yet the case.
Okay, thanks, Patrick. Yeah, it does seem that the EM region will be a hotbed for SLBs and Luis in Brazilian Treasury. I mean, is this a product that you're looking at, or what's the sort of framework you're looking at for your debut ESG issuance?
Oh, thank you very much. Unfortunately, there's not much I can disclose at this time, but what I can say is that unfortunately it took Brazil a little longer than it took our peers. But we are sure that we will have a very interesting things to announce in the near future.
Okay, great. Oh, thanks for that. We look forward to hearing of Brazil's ESG issuance plans. I want to turn the discussion on to ESG ratings. As we saw in the presentation and in our survey, that is becoming more embedded in the investor relation activities of SSAs and more so for developing markets. Sorry. Maybe I'll turn to Gregory again about the ESG ratings. I mean, is this something you're seeing more from EM sovereigns? Are they, you know, what is the sort of the activities around this ESG rating being embedded more?
I think we're all moving in the right direction, and I think you know, it's a late start for sovereigns. I guess the thinking around ESG has been much better developed for corporates, and now it's picking up with sovereigns, and you're seeing that in the ratings, in the sort of research we're receiving, and all sorts of things around sustainable investing. So that's a real positive. But I think we've still got a way to go. You know, in the main rating agencies are certainly integrating ESG risks in, and you see statements to that effect in their ratings, which is a real positive thing. In terms of the sort of the scoring of countries, it's useful, but it's subject to quite different methodologies from many different sources, and in some ways that's a strength because you know, there's many different ways to define ESG, but also it makes it a little bit difficult where you haven't really got a market consensus. But as I said, I'm positive that we're moving in a direction, but still some way to go for sovereigns.
Okay, thanks, Roy. And Abhishek Kumar, State Street, see your hands up. Yeah, please do go ahead.
Yeah, thank you. Yes, ESG bonds are very different, and I guess there's a lot of ignorance and sort of a lot of understanding that investors still have to go through to figure out that all ESG bonds are not the same. Like, and again, in terms of issuers as well, I think there is a better need for issuers to have at least some sort of best practice. Like in some cases, if you think of what most issuers would think of, like at least alignment to ICMA or CBI frameworks is absolutely the bare essential. But one sovereign came in last year without even that as accreditation. Now, use of proceeds is also patchy. Different issuers have different use of proceeds. The time period that they consider is also very different. Verification of third-party opinion is scattered. Now, surprisingly, or the good thing is at least you have one local champion who does things really well, and some of the and therefore I guess it touches a lot of things like what should the investor relation teams of these issuers be doing is to engage with buyers and talking about first amongst themselves what is the best practice that each of them is going through, and then talking to buyers and see what investors want in these issuances. Obviously, it's very important to understand that in the market is fairly hot now for GSS bonds. So if issuers bring in any bonds, it will most likely be literally bought by any issuer. But it doesn't necessarily mean that you build relationships, because eventually 5 years down the line, when the market has stabilized, these bonds will, as I say, I like the word, they'll become orphan. No one will want to buy them, or those who have bought them, no one will buy it off you.
Okay,
so it's quite important.
Okay, thank you. We'll come back to you. I just want to get some borrowers' perspective. We'll get your question as well, Brian. I see your hands up. But just to get some borrowers' perspectives, Petra, Have you got a response to what Abhishek's been saying about the need for issuers to integrate more best practices and investor relations activities around this?
I mean, perhaps for Greenmount, what I find important is that it's a clear picture what you buy, just to pick it up, what we just discussed, because we have a framework where I always was quite keen on to keep it easy, you know. Sometimes I said it's a one product strategy. So we framed our biggest programs, like the renewable energy program and energy efficient housing, just because then we have a big volume to place into the market and to have a kind of liquid bond, right? Because I look at it like a liquid bond, which is 3 billion plus. So we took this market out of this niche element, so to have a product which is interesting for investors. And in addition to that, we also issue like private placements, where we more have a look at the investors and not so much at liquidity. But this is quite clear what you buy, right? You buy either this product or you buy the other product. Regarding the premium, that's something which the market has to develop, because we don't issue those bonds in a different way than we do our normal benchmark bonds. So traditionally, you always have at least 1 basis point premium, because those bonds, if you have the alternative for two similar products and one is green and one is not, we always achieve at least a basis point. That has been more in the past, but it's something which is kind of depending on the market conditions. And regarding ESG ratings, you know, that is where we came from in 2014. Actually, what we want to have is that people look more at an institutional view. And to promote that more, we, as I mentioned at the beginning, we have a look at it, at ESG ratings from our banks. So just to come into a dialogue and to take it into account. And also we publish it on our screens, if we mandate green bonds, our own ESG ratings, right? So from two sides, looking at the ESG from the banks where we work with and more actively promoting our own ESG ratings. That creates at the end of the day questions, which we take up in investor relations. And we also actively communicate if there is something where we think investors should be aware of. So we try to establish the dialogue, which is quite a good one, and which is getting more intensive just because there are more transparency rules coming up now out of the regulation side.
Okay, thanks, Petra. Come to Brian, just to bring Isabel into the conversation and get your thoughts on what's being discussed here around ESG, particularly around your thoughts on ESG ratings as well, please.
Yes, thank you. I find ESG ratings are not as uniform in what they're looking at as credit ratings, and that creates an automatic problem. So is it looking at the effect of, say, the environmental social impacts on a firm, or is it looking at the firm's impact on the environment and on social issues? And, you know, people are rating very different things and looking at it from a very different perspective. So one doesn't get a very clear view from rating agencies that are focused specifically on ESG ratings rather than the credit rating agencies which are integrating their ESG perspective. When credit rating agencies put out their methodology and they're looking at changes to the methodology, they have availability for comment. You are able to say, I don't think you're taking account of this, that, and the other, and then they decide what it is that they're doing. But there really isn't the same kind of process for ESG ratings and looking at their methodologies. So they tend not to have specific methodologies for sectors. So, for instance, the one that is banks and corporates often gets applied to sovereigns and supras and agencies. And you can find yourself getting hit negatively on things for very little that's connected with ESG. So, for instance, I think most multilateral development banks, which are very focused on inclusion, will find themselves rated down, for instance, by one or more of the ESG rating agencies because we don't have cash points. And that's considered, therefore, to be poor on inclusion when you've got bank in the title. Now, that's clearly not relevant, but because it's being done as a desk job, rather than being done with a real understanding of the institutions, how they operate, what their aims are, where the risks are, and so on, that's really problematic. And I think many of my peer institutions and I have focused on trying to make sure that we're putting out a lot of information through GRI reporting and other things that will allow investors to really understand and put them into their own frameworks. And I think that one of the things that I find somewhat frustrating is that in the global financial crisis, the regulators came out and said, really, it's a problem that people are just automatically taking credit ratings. They're not doing their own investor work to really understand the institutions. You should use it just for information. And then on the other hand, there was, it's important that investors, as part of their fiduciary duty, do ESG integration and aren't terribly concerned about whether or not people are using and importing ESG ratings without doing their own homework. And I would say that it's at least as important, if not more important, in relation to that. And therefore, issuers should try to ensure that they're putting out a lot of information on the institution itself through ideally something that's comparable like GRI and other types of things that really allow investors to do their own work and not rely on this sort of very different ESG rating agency approaches to trying to understand ESG integration in an institution.
Okay, thanks, Isabel. That's a really interesting insight. I'll come to you, Brian, then for your question.
It was just a comment to try and address the bifurcation between issuance, ESG-related issuance in DM versus EM. And this is a very personal perspective. I tend to see ESG-related issuance as trying to do one of several things, which is trying to do good just because you really believe in the environment, or trying to get cheaper funding because, otherwise, if you don't tell an ESG story, then you pay more, and also trying to improve your investor base. Now, when you then look at that differential between emerging and developed markets, emerging markets are always facing this pressure of trying to raise cheap external funding. And then an ESG related story becomes something that helps them, one, widen their investor base, and hopefully with enough of a greenium option, raise cheaper funding. You don't have that pressure in developed markets, generally speaking. And for example, when the US Treasury is issuing, we are going to participate. We don't even talk about ESG rating for the United States, right? It's always assumed like this country is good, the UK is good, Germany is good. We don't talk about it. But Cameroon comes to the market, Chile comes to the market. The first thing that comes in, because I sit in a global sovereigns group, the first thing would be, where's their ESG ratings? So what am I trying to say? There's a differential in the treatment, and that differential in the treatment then incentivizes emerging markets to try and find cheaper routes and do more. And I think that's why you see that bifurcation. In developed markets, at least at the more at the sovereign level, what we're seeing is the issuance is mostly like for autonomous regions and provinces in Canada, or semi-governments in Australia, where it's green issuance, but it's project linked. That's where we're seeing it. But that differential in treatments between developed and emerging markets, unless that's addressed, unless developed markets are punished for not doing green stuff, I think you're going to see that difference persist over time. Nothing much to add around, standardization of documentation and ratings. All of those things are needed, but that bifurcation will persist as long as investors treat these two groups as different. That's how I see it.
Thanks, Brian. Jane and Harvey, I think you had a question around ESG matters, or do you have a response to anything being discussed here?
So would you mind repeating the question?
Sorry, did you have any questions around the ESG issues of sovereigns?
I wonder you think that some of the development market issuers are missing a trick by not doing sustainability linked bonds.
Yeah, I mean, lots of interesting question discussed. I mean, on the SLB side, I think actually it's not just about finding cheap funding. I think it's the SLB instruments have a very crucial function to assure that sovereign investors link their commitments on the environmental side in particular, and Uruguay was a perfect example of that, to their financing cost. And I think it's it goes beyond greenium. It goes beyond trying to find cheaper funding. I think it goes to to leaving the skin in the game and connecting the commitment that these countries are making on the multilateral level, being to commitment towards the Paris objectives, to their funding costs. And I think it's not just about that single issue that this attaches to. I think there is a possible positive impact that this can have to the rest of the curves, because ultimately once the sovereign issuer commits to that particular objectives, the entire curve should benefit. And again, I don't think that the greenium needs to only attach to use of proceeds bonds or to an SLB bond. Again, I think that once sovereign does focus on the ESG issues at hand and continues to improve, and Uruguay and Chile is a perfect example, I think the market automatically starts to price in that greenium, that sort of extra quality into credit spreads. And I think that's something that sovereign issuers shouldn't underestimate. And I think the SLB market generally, can act as a very important conduit to sensitize market participants to the pricing of some of these features that previously have been very isolated and the sort of ESG part of analysis. But now I do believe that investors are trying to integrate them into credit risk, and this is a very important instrument to do that. So I think there is something greater than just SLB being an extra instrument that issuers can diversify into. I think that there is other elements to that can be very beneficial for the development of the market and for the fulfillment of other sort of greater objectives.
Okay, thanks, Jana. Before we go to Petra, Simon, I think apologies we kept you waiting, but yeah, please do go ahead.
Yeah, hi. I think I tend to agree with Brian with the comments that he made. One has to be open and candid, and especially within emerging markets as well. You have Africa, which is at the receiving end of global warming, while at the same time emitting maybe only about 2 to 3% of global CO2 emissions. So it's these are countries that desperately need capital and are not getting access to the capital that they need to fund reforms, to fund infrastructure, to fund even socially and environmentally productive projects. And the thing here is that it's difficult, just from a moral point of view, to impose all of this ESG requirements on sub-Saharan African countries in particular. We desperately need these funds. And that's why the debt for nature swaps are probably an interesting approach, but still we need the funds to invest in these things. And we know it because we are funding also alternative energy projects within sub-Saharan African countries. But the priorities are huge in development on the developmental side. And I think finally, just to wrap up, I think developed markets, I think somebody was alluding to this, need to co-finance or provide co-financing or subsidizing into bonds in, for example, sub-Saharan African countries so that they can issue ESG bonds, but maybe at a lower premium. I think I'll stop there.
Okay, thanks, Simon. We're sort of fast approaching the end of this event, but Petra, you had a question. I'll come to you now.
Yeah, actually, I wanted to react on what Jana said and also a little bit on what Isabel said, because first coming on Jana's comment, which I absolutely support. I mean, because we issued green bonds, or we as issuers, and we show more transparency, and ideally everybody can see what the difference in the issuers is and how big their part is on green, the whole curves will trade tighter, and that structurally will bring us to a lower greenium, right? Because with having more an issuer view, meaning that all the bonds we issue as an issuer will benefit and our curves will tighten in. So there is no need for a big differential between a green bond or a conventional bond. So structurally, I would definitely support this development, and also same on the ESG rating side, you know, we need those steps from my point of view, coming from those with all those inefficiencies which ESG rating agencies have. We might end up, or that would also be my forecast, that the credit agencies, they just integrate now all those criteria. And so at the end of the day, we end up in the normal structure of bond markets, but having integrated those criteria. So this is, for me, it's step 2 in the sustainable market or whole market approach, just to bring that into the context. So I would definitely support.
Thanks, Petra. I wonder if we might just finish with a quick hands up straw poll of our panelists. Put your hand up if you think that within 3 years, the big developed market issuers will be issuing sustainability-linked bonds. Only one of you. Okay, that's very interesting.
Or 2.
2? Not many. Very interesting. Okay, well, Jana, maybe you can keep banging the drum, and maybe it will happen. Yanis, can I just come to you? Just closing thoughts on what you see as the outlook for the rest of the year. Just a couple of minutes. We're already overrunning. But you're on mute again. No, we're still not hearing. I think we'd better move on. If we can see Yanis's mic come on, I'll bring him back. Today, Yanis, there we go. Excellent.
Okay, sorry, yeah, this system is a bit tricky. So I think, I mean, as we discussed before, I mean, we're obviously having a very positive market window right now, which lots of issuers are taking. So we're seeing lots of pre-funding, more pre-funding than we have expected, more pre-funding we have actually seen at the same point of the year last year. I think, given the still elevated volumes, I would expect issuers to continue to make use of windows and continue with this pre-funding. We have an interesting opening in the long end seen this week actually from the EU, the 30-year point, which was not on many people's radar going into the year, that demand on the long end could be as strong. So I would expect to see a bit of a pickup here in issuance. We've already seen one follower after the EU transaction. And otherwise, it should be very much the same as usual, right? Our borrowing plans structurally aren't much different than last year. There will be obviously a big weight on the euro market with 60-70% of funding volumes. Dollar market continues to be challenging cost-wise for many European SSA issuers. And then obviously the focus as windows present themselves in the smaller niche markets, Aussie and Sterling have been quite popular year to date. But we haven't seen much, for example, in the EM currency, so in the smaller DM currencies yet, right?
Thanks, Yanis. I
very
suspect,
quick.
given the relative gloom of December and the ebullient nature of January, the best thing to do is to continue to expect the unexpected in financial markets over the next 12 months. But sounds like encouraging signs. I want to thank everybody who's taken part in our discussion today, the borrowers, the investors, to JP Morgan as well. You really learn that these are complex markets, and the dialogue that exists and that should happen between all sides of the market is extremely important to their development and their proper functioning. We've certainly enjoyed hosting the conversation. There's a conversation we'll continue to host. In the coming weeks, we have a session on February the 16th, specifically on Latin American public sector issuers. In early March, we have a workshop for issuers from Central Eastern Europe looking at the GSS bond market. I'm sure sustainability-linked issues will be a big topic there. We'll be doing something in Paris around European agencies and sub-sovereigns at the end of March. And what we will certainly be doing in May, or in the middle of May, in our public sector debt forum, is bringing together people in person to discuss the issues that we went through today in even more detail, and hopefully continue this constructive dialogue that we're very pleased to be part of. So thank you to everyone who's joined us online today. Thank you to all of our speakers, and we look forward to seeing you all at the next SDI event soon. Thank you very much indeed.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you.